Hello everyone, this is Mark from Right Line Trading, and I just wanted to go over our volume hammer indicator and to show you why it's highly likely that the volume indicator that you're using does not work. There's the volume hammer, and this is its tracing. Now, if you take a standard volume indicator, and almost all of them use this concept in one way or another, what they're doing is they're telling you the number of contracts that cross per candle. Now, I've seen all kinds of self-appointed gurus tell you to look for volume spikes and information about how to trade volume. So essentially what they're telling you is there's the number of contracts crossing per candle. And that's the spike, and that's the absolute number of contracts if you look to the right. There's the graphical representation. Now, unfortunately, here's the reason why this just does not work. There are two independent variables operational at this time. One is the number of contracts that are crossing per minute, and the other is the number of candles that are forming per minute. Now, we've all seen in some markets an enormous amount of volume cross, but the candle simply doesn't move. The power of the bulls equals the power of the bears, and you're going to get an enormous volume spike form under the candle simply as it just sits there and accumulates volume. And that's also going to occur during a period of time when volume accumulates slowly, but the candle moves slowly. Again, the power of the bulls equals the power of the bears, and you're going to get what appears to be a volume spike simply because volume is accumulating underneath a candle that's not moving. That in no way provides you with an accurate assessment of how to trade volume, because volume should be based on one independent variable, and it should be independent of the rate of candle formation. And that's what we've done at Right Line Trading. The volume hammer traces out volume in contracts per minute. It ignores the number of candles forming. This number here is also assessing contracts crossing per minute. So there's absolutely no correlation between the volume hammer and standard volume. Now, the only thing that we can look at is the right edge, because the volume hammer is tracing out it traces out intra-candle, and it traces out a new bar or a new line every single minute, while this is tracing out a new vertical bar every single candle. But what we can see here in the close of the market, right here, when the two finally are looking at the same candles at the same time frame, you're getting volume spikes into the close simply because the candles are just sitting there. But if you look at the volume hammer is flat, and it's telling you that almost no contracts are crossing. And that's what you want to trade. About 136 contracts are crossing per minute on crude, which is horrendous. But if you look here and you look retrospectively, it looks like you've got a volume spike here initiating this move up. It's just not, but it's really not happening. These candles are simply developing, forming, and moving so slowly that volume just accumulates under here, and what you're doing is you're trading a market with absolutely flat volume. Very dangerous to trade. So what we look for with the volume hammer is whether it's a big up move or a big down move. We look for volume to rise into the move on an up move and volume to rise into the move on a down move. And this is a true accurate assessment. Now, what happens when candles form really quickly? Now, volume may pick up, but the candles may fire out so quick that there may not be time for any volume spike to appear. So what you get is this little spike here. But in fact, there must be maybe an enormous amount of volume turning here, but the market just fires up here. So you need a volume indicator that assimilates data based on one independent variable, simply the number of contracts crossing per minute. If you look at the indicator, you can determine the interval. Now, I like to see it. This is one period. It's going to occur every minute. You can have it occur every 2 minutes, every 3 minutes, every 4 minutes. Or you can have it occur every 60 minutes. Just you're going to get a line once an hour, depending upon the time frame you're trading. If you want one to occur every 4 hours, every 240 minutes. So, as I said, I like to see, because we trade in 8 range, I like to see it occur every 1 minute. And it gives me a very, very accurate assessment of volume. All the other volume indicators, standard volume indicators in NinjaTrader, and all the other packages simply are totally inaccurate because they have, again, 2 independent variables. Not only are contracts per minute a parameter that goes into the formation of this line, but so are the rate of candles forming per minute. You can't have 2 independent variables tracing out one line when you're only interested in one parameter, and that is volume. So I hope it's clear why the volume indicator that you're using simply does not work and why the volume hammer solves that problem. You can watch as the volume rises on a minute-to-minute basis as the move matures. And that gives you the solid foundation for taking a trade. Take care, everyone, and I look forward to seeing you in the trading room.